The Federal Reserve has been raising interest rates to slow the job market and cool inflation, but surprisingly, jobs surged in January. Will the Fed keep rates higher for longer? Joining me now, Wharton School professor Jeremy Siegel. Professor Siegel, thanks so much for coming back on the show. We appreciate it. So let's start. I think we have to start with Friday's blowout jobs number. Does that put pressure on Jerome Powell and the Fed to keep rates higher for longer?
Yeah, it does. But we have to recognize that there's still 6-7 weeks until the next meeting. A lot more data is coming here. But no question about it. Friday's data blew me away. Really, if you combine the jump of hours with the increase in the labor supply, you have 1.2% in 1 month is a near record increase in total hours worked.
Wow. So let's get an idea of where inflation stands right now. Most frequently, we hear it cited in a year-over-year number. But if you look shorter term, are we seeing a little bit of a reduction?
Yeah, and I really want to push back against year-over-year. Year-over-year is 11 months of old data and 1 month of new data. You really should look at the last 3 months or even the last 2 months with other price data, and that shows a dramatic slowdown. And particularly if you take out the housing market, which is computed with a big lag by the Bureau of Labor Statistics, you even get a negative rate of inflation over the last 3 months.
So another really important data point, of course, is wages. I mean, the whole reason that the Fed is trying to slow the jobs market is so we don't end up with a wage price spiral. On Thursday, we got a number that looked comforting in that realm. Well, what are you seeing?
Well, certainly, and even the Friday had earnings that were wages that were very much in line. I think the Fed is pushing back too much on wages. One has to realize that workers have fallen 4 or 5% behind inflation over the last 2 years. So we should expect some catch up. And to say that you cannot go more than 2 or 3% sort of, dooms workers to have permanently fallen behind inflation. So I think that there's too much emphasis by the Fed at the current time on keeping the wages under control. We need higher wages to bring people into the market. We know employers want them. We know job openings are extremely high. And I think the concentration should just be on the price front, not on the wage front.
All right. So from this point on, what do you expect the Federal Reserve to do, and what do you think it ought to do? I mean, we all know that the actual rate hikes don't fully integrate themselves in the economy for quite some time. So is there a danger we could push high now and have a crash later?
Absolutely. And in fact, Jay Powell already says, the biggest force of monetary policy works with a lag. And it's sometimes 6 months, 9 months, 12 months. So this tremendous tightening, one of the greatest in history, its effects have not been felt. I would prefer that they stop now. I think there's enough evidence that the prices are down, that they could pause and wait and see the course. I think continued increases will increase the risk of a recession in the second half of the year. Hard to believe given this blowout jobs report that we had Friday, but that can turn around very, very quickly.
Okay. Let's pivot to the markets. On this very show in March of 2020, you said that you thought that the Dow could hit 40,000 by 2025. Do you still like that prediction?
I still think so. We have another, two years of the market. How much would that be each year? I haven't done the actual calculation. Huh?
About 7.5% a year.
Yeah, that's very reasonable. On the Dow, in fact, that would actually be, I think, below its long-term post-war average. So I still think that that's a very eminently reasonable projection, and in fact, it could go higher.
All righty. One more question before I let you go. Putting all of this together, what areas of the stock market look best to you, the author of Stocks for the Long Run?
Well, we had so many years of growth outpacing value, and last year was a big turnaround. My research shows it's usually not a one year phenomenon. Now, I know we had growth run a lot in the first in January. To be sure, it did very, very well. But I wouldn't be surprised to see value stocks, low price stocks, dividend paying stocks, low PE stocks reassert themselves as the market leaders through the remainder of 2023.
Yeah, in a higher rate environment, that does make sense. Professor Siegel, thanks so much for coming on the show.
Thanks for having me.